Welcome to the Boyer Brief. I'm Mark Boyer, and this is Jason Jacoby, the clean-shaven Jason Jacoby.
I'm a new hire around
Who
here.
are you?
I'm a new hire.
Things have been rough in the markets, and he's kind of taking your hair off. Even.
Yeah, a lot of stress. Lost my beard.
Yeah, lost your beard. So, well, we're good to be back with you for this Boyer Brief. Let's talk about a few things here. What's our agenda today?
Yeah, so we got a good one for you. Some hot topics we'd like to say. Thought it'd be kind of a good route to go this month with a lot of news that's come out, especially today.
Yeah.
But inflation, talks of recession. How can we find some value in the uncertainty of the markets these days? How do we wade through that?
Yeah.
And then also talk about some of the housing pricing and what that has to do with the inflation.
Some topics. So today, inflation hit. Wow, we got a big hit today. Markets took a dump. It's Friday. It's the 10th of June. Inflation came in this morning at 8.6%, which was slightly higher than expectations. So it was sort of a shocker in the sense of, there was an expectation it might be a little lower.
Yeah.
So it's the highest in 40 years. December of 1981 was the last time we had this kind of height of inflation. So the CPI number is pretty high, and then we were all feeling it, right?
Yeah.
It's kind of been an issue this whole year, actually last year or so. Longer than a year, but recently, we're hitting these high numbers. So it's kind of tough, and the market didn't really expect it. Was actually hoping that we had seen some bottoming there, or some, that we are getting a place where we're actually going to see some bottoming in regards to some reduction, but we didn't get that today. But core CPI actually, taking out food and energy. Which, how do you take that out? We all do food and energy. Gas prices are off the charts. Food is off the charts. It's kind of crazy. But taking those out, we are down slightly. Trending down. So goods, in fact, are actually dropping. But we still got issues with the service inflation that's kind of there. So so the markets are reacting today, and I'm not surprised. We're going to retest the recent lows, probably of May lows, and then we'll see where it goes from there. But there are some good news in there. It actually looks like it seems to be contracting less, especially that core CPI.
Yeah, exactly what Mark said here. So if you look at the charts on the screen in front of you there, energy obviously through the roof. We've all feeling that in our pockets.
Yeah.
We'll talk about that in the next slide. But basically, energy and food, two of the biggest factors of the CPI numbers. And core inflation is coming down, 4-month low, actually 6%, like you said. So that's good. So that's a good sign that if we can get the energy and the food inflation a little bit more under control, at least see those deflate a little bit, then that could be a good sign for our economy. The quicker that gets handled.
Many people think we're kind of, we're sort of peaking and maybe starting to come back down on some of with that core number coming down. So we'll see. It's going to be a longer game than we expected, but we knew it was going to be an issue coming into this year for sure. So. And they're saying blaming Putin and all these things. Inflation started a while back. Hopefully, it'd be nice if they just open up some pipelines again. But obviously, that's not going to happen. So it'll hopefully work its way out as we keep going here. So
absolutely. And what you were mentioning before with groceries and gas being the two biggest here, as you can see on the screen, average national gas price as of this morning here, $4.97. That'd be nice if gas price was that around here, right?
Yeah.
I mean, it's almost $7
Southern
locally.
California, right?
Yep, $6 and change, almost $7 for premium. Craziness at the pump, but also grocery bills up 10% year over year, which is a lot. Specifically, chicken and beef and poultry, things that we get a lot of imports from, or that utilize mechanisms that might use fuel or things like that, right? They're trying to pass the cost of goods on to us. So it's pretty high.
Yeah.
It's pretty high.
Well, fuel prices are everything, right? So if it takes, if you got high, gas and diesel prices like we have right now, it affects everything.
Yeah.
And so as long as that's going to be the case, we're going to be dealing with that in the energy and in the food space for a little bit of while. So, and then wage increases are also driving inflation higher. It's a pretty tight labor market at the moment. It's adding pressure to more jobs and job seekers. So those labor costs are stemming from worker shortage, and we could go along, spend a lot of time talking about that, but it's really interesting to see what's happening there. I was talking to a buddy here recently that owns a construction company, actually just yesterday, and he was sharing. He's a non-union guy. Anyway, he was talking about doing his jobs, and his business has been great, but he's got some. There's been groups actually on job sites where they come in actually with a bullhorn and then offer signing bonuses to his employees if they will leave today to go with them. These are competitors, and so he's having to up his employee costs in order to try to keep people working for him. It's kind of crazy. So that's causing obviously some problems as well. And so that's an issue for the job part. So hard to be a construction owner and deal with that every day. It's got lots of business, but the costs are all ramped up that way. So anyway, kind of a challenge.
Yeah, and I'm sure going along with that, the supply chain issue that's come and gone, not come and gone, but eased and then gotten worse again with the China lockdowns and importing of goods and the time frame that it takes to get the lumber, the steel, specifically for construction, another industry that relies on that. Yet the price is increasing. So not only are you dealing with the labor force, you're dealing with the supply chain and the cost of the goods as well.
So there's issues that, like in that example, I mean, just again, a company who has to adjust, make changes, and it affects them. They have to adjust prices. But that's kind of like the overall economy. Everybody's trying to, maneuver and figure out where we are and make those adjustments to keep it going. The good news is, in this capitalism system, when we have a system like we have now, people do that. So it takes time to work through that, and that's why markets react and do what they do. But overall, longer term, we adjust and we move forward. So it's
good point.
That's really it's a good thing, but it's painful in the near term.
Good point.
So
I like that. So big question. Recession looming. Are we going to have one? Are we not? Are we in one? That's even the topic these days. Are we already in one and we don't even know?
I don't think so. I think we have a chance of possibly having a recession. I don't think we're in one yet. Interesting, the consumer still continues to be pretty strong. I mean, it's really, especially on the high end, people are traveling. I think since COVID opened up, there's a lot of money being spent still in places. It's hurting the lower wage earner for sure. And so that's longer term, that's an issue, but it's interesting that so far the consumer's been pretty strong and the numbers have shown that. And so we'll see if the consumer can keep that up and go forward. If it goes on a long time, we'll probably see a recession probably in 22, or 23, excuse me, but don't think we'll see one here in 22 in the near term. But we'll have to keep playing that out and see what's happening. But even if we hit a recession, it's interesting with equities and stocks. It doesn't mean that everything stays in the tank for a long time. So share that little, talk about a little bit the difference in what it looks like as we go into a recession in a year or 2 years later.
So a lot of people, I mean, even myself being younger when 08-09 happened, I mean, you remember that, everyone remembers that vividly, that everything, there was no safety at that point. Right. The markets bottomed out, bond market, housing market, everything just collapsed. Recessions don't have to be like that. A lot of times they're not. Recessions are a healthy, I'm gonna say healthy in relative terms, a healthy part of the business cycle. They're inevitable, you can't avoid them. They're good because it basically, especially with probably this next recession, we'll see some imbalances play out and get fixed a little bit because of the run we've had, especially over the last few years. And again, just correcting some of that inflation issue that we've been having and labor force participation, things like that have kind of become headwinds for our economy. A recession will help that become fixed. Yeah. So with that being said, an average, so if you see a chart, I don't know if you can see the numbers up here, but on average, if you look at the S&P 500 returns from peak to trough, so from highs to lows, in a recession, it's about 24% drawdown on the S&P 500, with a bounce back a year later, so a year from the lows, a bounce back of 40%, and then 2 years from the lows, 54% return. So when we talk about having patience, having that long-term mindset, is very, very important, especially as we go into a recession, possibly going into a recession, and letting that play out.
Yeah, again, because of the fact that as corporations and companies, and like the example I gave, business owners adjust to the current circumstances, they make those adjustments, and then it kicks in for future growth and sets them up for longer term as the economy comes back and begins to grow again. So yeah, it's interesting. I mean, it's always concern, and our emotions get really high, and the fact is that it's proven that longer term, if you keep your long term perspective, it's really, really important.
Yeah, you get rewarded.
Yeah, you get rewarded. So really good. What about the housing market? What do you think? I mean, let's talk about that. People think we're in a bubble.
Yeah,
possibly.
Yeah, absolutely. So I mean, obviously, inflation plays across the board into this as well, and supply is really low right now. I think talking to a lot of my real estate friends and just hearing the echoes in the industry with supply being low, it's still a seller's market because inventory is low. So people that want to buy, who are still buying now, will pay premium top dollar for it. Yeah. Actually, the two charts that I chose today were the luxury market, because those are kind of the things that cool off. I think first, those people that have a lot of money, you're starting to see that willingness to buy at a premium price, it has come down quite a bit.
Yeah.
You look at the average 30-year fixed rate of mortgages right now, 5.4%, up over 2% from 2020 or even the last year, right? Yeah. New mortgage applications have fallen about 7% for the week, down 21% from a year ago. And then refinances are down 75% year over year, which again is understandable because rates were low, so you had a lot of people refinancing. But that's just, again, people are becoming more cautious, more cost aware, which is a good thing. But for the time being, as long as there's low supply, housing prices should stay elevated for the near term. But as inflation stays high, people get more concerned or willing to spend less. I don't think it's going to be a bubble where it's going to burst and become like 2008, where it's going to crash. Could prices come down? Absolutely. It's healthy.
They should come down a little bit, but they're not going to crash.
Right.
They're not going to go into a depression or anything, or like we've seen in other times. But it should come down. And anytime you have to borrow more money at a higher interest rate, it's harder to do. So again, have another client who's trying to sell a house, and waited a little long, and they immediately in the spring here realized, based on just the lack of usually a predominantly pretty healthy market where the houses have sold, all of a sudden it's sort of slowed down pretty quickly. So here in the last month or two. So anyway, that'll probably persist. I don't think we're gonna, like you said, gonna drop significantly, but it'll should slow down a little bit and give some people a chance maybe down the road to buy some houses.
Like me.
So good stuff.
So what's next? So we've got recession talk, inflation's high. It's a possibility we go into recession again. It doesn't have to be all doom and gloom, but what are we focusing on here at Boyer Financial? You as El Presidente, leading the ship here. Where do we go from here?
Yeah, so I think it's important to remember that in investing, you try to build portfolios that we consider all weather. What does that mean? Well, I mean, all weather, there's a spring, there's a summer, there's a fall, and there's a winter, and so you're trying to build a portfolio that can handle and work through all those different areas. Now you adjust, obviously, it gets cold. We're not quite in the spring or summer anymore. We may be in the fall, even in the winter somewhat. And so, it's important to realize that, but we've already built portfolios that are trying, that are working through that. And so give us a chance to, basically offset any major deals where if we need money, an all-weather portfolio, if you ever need money or need to make adjustments, you find something that's in a cycle that's more attractive, that you can take your money out of those places that haven't gone down as much as so forth. This year has been a little more of a challenge because we've got not only equities have struggled, but the bond market has also struggled this year. But we also parts of commodities with oil stocks that we own in a lot of our portfolios in different areas have gone up. So point is, keep your all-weather portfolio. It's really important, and that's what we've been working, and that's what we do at Boyer Financial, is try to develop that with our clients. A portfolio that for the long term, for what they're risk tolerance is and their time frame that fits their needs. And so I think it comes back to kind of, and I always use the sports analogy, having an offense and a defense. You got to play offense and defense in a game, but your goal is to have some, an offensive attack. You got to play, you got to hold on sometimes in the tough times, but you got to have a portfolio or a game plan that you can make other things happen and adjust as you need to. So important to stick with that. That's really critical. Yeah. Then I think on another area I'm telling clients is that, this is a time too, as far as playing, talk about playing offense, or, it's time to play a little defense. And one of the areas that's really important in times like this is to, especially with large purchases, maybe there's something you've been wanting to buy or whatever. If you can hold off, I just make this recommendation, if you can hold off on making larger purchases during this time, that would be much better. The idea being like, hey, you got to take money out of your, funds that are down or whatever, your stocks, your bonds, to make that purchase. If you can hold on a little bit, and let that, recover like we talked about based on the numbers here, better. So in those situations where you can hold off on those larger purchases, probably a little better advice to keep your powder dry at the moment.
It's great advice. I love that. And also, just going back to talking about the all-weather portfolio, I know you and I, we love the active management style of things. Whether it's a mutual fund that you've got the investment managers actively managing that. I mean, they're all investment professionals, and this is their day jobs. They do incredible work. Or you're using a passive ETF portfolio that we're actively managing, or our team's actively managing. It's really, I think, a place to be at this point. I think you would agree with that. Is active management is a good place, especially trying to be selective, especially in a market like this, of where's the growth going to come from, where's the income going to come from. Again, going back to the risk tolerance, your time frame, your goals and needs, cash flow. So why don't you dive into a little bit about that?
Well, it's a stock picker's market. I mean, these times it's like you've got to have active management, whether you use passive index funds or ETFs, or we're using some of the best money managers in the world that have been doing this for 90 years almost, and so I think we got to let them do their job in these periods of time, making those decisions and helping us manage our money in those. So again, key is for us not to get so emotional, to remember what we've built, this all-weather portfolio, that we got a game plan, even though with all the noise and all the things happening around us, we got to stay to our plan and we got to stick with it. And long-term, to handle our short-term needs, but also to make sure we don't hurt ourselves longer term. So that's really, I think, really important. I think active portfolio management is really important at this time.
Absolutely.
So, yeah.
And then to go along with that, a lot of our favorite style of equities, dividend payers, dividend growers. Great place to be, attractive place to be.
Yeah, to the point, if we're in a fall or winter time, you want dividend payers that are companies that are paying dividends and increasing those dividends along the way. Incredible, I mean, you're getting better dividends sometimes some of these fixed, these large cap equities that you are getting right now, although in the bonds, but that's coming up now as yields go up. But point is that, we like the healthcare area, the industrials, the energy's been great, financials, as long as we don't go into recessions, financials can be in a good spot. And even the tech giants, like, companies that are kind of dealing in the large cloud growth area, like Microsoft, AMD, Taiwan Semiconductor, some of these companies that are really, really solid, that
Microchips.
We like those too. Yeah, so those are great opportunities. A little more, again, not for a super,
near term.
I mean, we don't know in the near term, but longer term, boy, just incredible opportunities, because any technology like that's not going away.
Correct. Yeah, I would agree with that. So obviously, bottom line, some key takeaways I'm getting from listening and learning from you is maintain balance during this tough time. It's going to be volatility's here to stay for the time being. I think we've preached that for quite a long time.
Talked about that before.
Removing the emotion as well.
Yep. Stay cool, calm, and collected, right? Stay in the pocket and keep playing. I mean, this is a really important time right now. This is where the biggest mistakes are made in investing is not sticking with your game plan, because say, well, want to get out and get back in when it feels wrong. Well, the problem is that you never know when those up days come, and so if you're out of the market at that time, studies have shown like you miss out longer term. It crushes your longer term, performance if you miss some of the 10 best days of the market, which usually happen in bottoms.
Yep.
Okay, so anyway, again, we don't want to hurt ourselves. We want to stay in the game. We want to maintain our our composure and keep our game plan and keep going. So and then check in with us. Talk with us. Let's talk, and that's what our job is to help you keep that going. And if we need to tweak, we can tweak. It's not a problem, but at least we do so with some wisdom and not make an emotional decision. Yeah, the emotional part could just crush it. It just so crushes. So,
absolutely. That's all good advice. And so basically what I'm hearing Mark say here at the end, since he's an offensive guy, Mr. Tight End, I'm a safety defensive guy. Offense is great, but defense wins championships.
Okay. So, but you got to score points too, bro.
Absolutely,
right?
absolutely. But having again that balance, that all-weather portfolio, if you can have that defensive strategy during hard times, then you have that ability to grow and to score points.
Yeah.
Then you're in a good spot.
Yeah. Yeah, and again, this is a great. Economy slowing down. It's a fact. It's what's happening, but it's not going to die, and we're not going to fall off the end of the into the ocean forever. Okay, so let's hang in there, and we'll keep going forward. Excited to work together with you as our clients, and we'll see. We'll keep going. I think honestly, from my perspective, I think it's going to be a little more volatile here through the summer.
Yeah.
And I think in the fall, even again, we've talked about this before, but midterm election years are typically like this, and we might get some clarity in the fall, September, October, where we think we're going to end this 2022 pretty strong. That would be my thoughts on how this year goes. A lot of volatility here with a good push at the end of the year.
I like it.
So
I like it.
All right. So
All
let's
right.
hang in there.
Well, for Mark Boyer, Jason Jacoby, we'll see you guys next month, and have a good one.